We've announced a 50% tariff on products from Brazil, and that includes beef.
Beef prices have soared to all-time highs, with many families feeling the squeeze.
Almost 90% of Americans now say they're stressed about grocery prices.
Beef has always been at the heart of the American dinner table, from backyard burgers to steakhouse ribeyes. Yet by the summer of 2025, families across the country are staring at grocery receipts with disbelief. According to the Bureau of Labor Statistics, ground beef climbed to an average of $13.49 per kilogram in June, the highest level ever recorded, up nearly 12% from a year earlier. What once cost $4.99 a pound just a few months ago now rings up closer to $7.99. Behind that sticker shock stands a major policy shift. President Donald Trump imposed a 50% tariff on beef from Brazil, the single largest foreign supplier to the United States. Before the tariff, Brazil accounted for between 21 and 27% of America's beef imports. In 2024, the United States brought in 229,000 tons of Brazilian beef, and in just the first half of 2025, 181,000 tons valued at nearly $1 billion. With tariffs this steep, that flow has slowed to a trickle. The question now is simple. If Brazil turns away from the U.S. and leans into Canada instead, what happens to the American market? In early 2025, U.S. buyers leaned heavily on Brazilian beef to cover shortfalls at home. Herd sizes in America were already at their lowest since 1961 due to drought and high feed costs, and imports filled the gap. By April, imports from Brazil peaked at nearly 48,000 tons in a single month. But the story shifted quickly. By July, the total plunged to less than 10,000 tons, an 80% collapse in just 3 months.
So I think we'll see imports from Brazil decline pretty dramatically simply because of that tariff. Now, that also works to reduce our supplies of beef, which works towards keeping prices higher.
The World Trade Organization has already received a formal complaint from Brazil, arguing that Washington's new 50% tariff on Brazilian beef violates international trade rules. Yet even before any ruling, the numbers tell the story. Without Brazilian supply, the U.S. market is losing an estimated 400,000 tons of beef a year, equal to 4 to 5% of domestic consumption. That gap is worth roughly $1 to $1.3 billion in trade value. It has driven wholesale beef prices up by 21% since January, according to USDA data, while consumer prices for beef cuts have climbed between 8 and 12% over the past year. Every link in the chain is feeling the pinch, from meat packers forced to pay more for cattle to burger chains deciding whether to shrink portion sizes or raise menu prices.
But what if Brazil, instead of sending its beef to the United States, redirected more of it to Canada? What would that shift mean for both markets? As U.S. tariffs shut the door, Canada has become a natural alternative for Brazilian beef. Ottawa reopened its market in late 2024, with imports already worth $39 million in 2023 and rising 44% in the first quarter of 2025. Brazil is also reviving Mercosur trade talks with Canada, a move that could further increase flows north. Though the overall volume is smaller than U.S. demand, Canada is seizing this moment to diversify supply and present itself as a more reliable partner while Washington looks unpredictable.
The implications for the United States are stark. Losing Brazilian beef means a tighter supply of grinding beef used in burgers, higher retail prices that hit household budgets, and billions in added costs across the supply chain. Importers face lost revenue or higher bills when turning to Australia or Argentina. Processors report thinner margins as boxed beef prices rise. Retailers see sales volume shrink even as shelf prices climb. Restaurant owners, especially fast food chains, admit costs are climbing faster than they can adjust menus. Meanwhile, Canada is not under Trump's shadow. It is strengthening trade channels, drawing new supply lines, and reminding global partners that it can be a stable counterweight. Trump's tariff gamble may demonstrate power at the negotiating table, but in practice, it leaves American families paying record prices while giving Canada a chance to expand its role in North American beef trade.
We've heard from Doug Ford, the Ontario Premier, saying that Donald Trump could pull the rug out from underneath NAFTA or CUSMA, USMCA, whatever you want to call it.
Yeah.
As soon as November.
No, Canada pulled out the rug from USMCA. He got that fact wrong, or he didn't. He doesn't realize this or that.
The United States-Mexico-Canada agreement wasn't meant to face its first big test until 2026. That's when all three partners decide whether to extend it for another 16 years. But well ahead of that date, the pact is already caught in a political storm. Warnings from Canadian leaders about an early reopening have met with pointed pushback from Washington, which accuses Ottawa of undermining the deal. Instead of serving as a stable base for North American trade, USMCA is being pulled into the high-pressure arena of tariff politics. The question now is whether this is tactical posturing, or the opening move in a reshaping of the continent's commerce.
The biggest U.S. complaint is the fact Canada retaliated at all. That harsh retaliation counter tariffs on things like orange juice, motorcycles, and appliances, goods that have been covered under the Canada-US-Mexico free trade deal, a move that has seriously upset the Americans.
From the White House view, USMCA is fair game. President Trump's team says every agreement is subject to review if it stops serving U.S. interests. Their chief complaint: Canada's retaliatory tariffs on goods that should be duty-free under USMCA. U.S. officials say that puts the pact itself in doubt.
We're starting to get closer and closer to the point where the president will want to reopen negotiations on USMCA. And I think that poses a bit of a risk.
So far, Washington has kept exemptions for Canadian goods meeting USMCA rules of origin. Losing those protections would pull a much larger share of trade into the tariff net, on top of the 35% already applied to Canadian exports outside the pact. According to Statistics Canada, 80 to 85% of Canada's exports to the U.S. now qualify for duty-free treatment. Removing that shield would raise costs on both sides, but it would also give Trump another powerful lever, just as he used with the EU, Japan, and South Korea to extract tariff caps and investment pledges. Ottawa is not approaching this from a position of retreat. Prime Minister Mark Carney's strategy has been one of strategic patience, avoiding rushed concessions while keeping communication channels open. At the same time, Canada is preparing the ground. Ontario Premier Doug Ford's public warnings about USMCA have been aimed as much at U.S. audiences as Canadian ones, highlighting the potential costs for American consumers and manufacturers if tariff walls go up. Policy steps are equally deliberate. Federal and provincial leaders are working to increase the share of exports that meet USMCA rules, ensuring that the majority of trade remains shielded. Canada is also deepening partnerships with Mexico, the European Union, and the United Kingdom, building alternate routes for trade in case U.S. market access narrows. And it holds serious bargaining chips. Canada is America's top foreign supplier of crude oil, natural gas, and electricity, and a key source of uranium and critical minerals for electric vehicles and semiconductors. In North America's integrated auto sector, these resources are not easily replaced without disrupting supply chains on both sides of the border. Under USMCA's review clause, a refusal to extend the deal in 2026 triggers annual reviews and the risk of expiry in 2036. Trump could push that process earlier by tying USMCA renewal to stalled Canada-US talks, widening the scope for concessions. Canada has options. One is a tariff cap similar to the 15% ceilings the U.S. granted the EU, Japan, and South Korea. Another is to strengthen non-U.S. trade alliances to offset American pressure. And given U.S. dependence on Canadian energy and industrial inputs, Ottawa can use that interdependence to protect key sectors. USMCA's early arrival in the political crossfire shows how fragile even modern trade pacts can be when national strategies shift. Trump is willing to make the deal part of his tariff-driven approach. Canada, under Carney, is countering with preparation, diversification, and strategic leverage. The months ahead will decide if the tension produces a workable arrangement or turns 2026 into a flashpoint for a bigger confrontation. Either way, the outcome will shape not just tariff rates, but the balance of economic power in North America for years to come.
Certainly sounds like Canada-U.S. trade talks are in a holding pattern. That is after President Donald Trump raised tariffs on certain Canadian goods. Some of the country's premiers are calling for retaliation.
Taking the American alcohol off the shelves, looking at the procurement process, we have to, push back for sure.
At midnight on August 1st, President Trump raised tariffs on Canadian goods not covered by USMCA from 25% to 35%. It was a dramatic move aimed at punishing Canada for refusing to sign a last-minute trade deal. Unlike South Korea or the EU, Canada stood its ground, insisting on a fair agreement instead of rushing under pressure. The tariff hit a small share of total exports but carried symbolic weight, signaling that even a close ally could be targeted. It marked a shift from cooperation to confrontation, straining a trade relationship long seen as one of the most stable in the world.
Canada is strong. We can give ourselves far more than anyone can take away. Building sustainably, building together, building positively, and that's what we're going to do. And yes, we'll come to something with the Americans.
But Canada didn't respond with noise. There were no podium outbursts, no rushed retaliatory tariffs. What followed was calm, measured, and quietly firm. Ordinary Canadians voiced frustration but not fear. They've seen this before. During Trump's first term, retaliatory bans on U.S. products, like removing American whiskey from shelves, caused real political ripples south of the border. That memory remains. Today, many Canadians favor long-term resilience over tit-for-tat escalation. The broader public mood in Canada has shifted. People are exhausted by cycles of unpredictability and power plays. Trump's approach is seen not as diplomacy but as theater. And Canada this time is choosing not to be part of the show. Prime Minister Mark Carney did not sign a last-minute deal like South Korea or the European Union. He made clear that Canada wouldn't accept a template agreement that didn't serve national interests. In public remarks, Carney emphasized sustainability and national self-confidence. He acknowledged the complexity of negotiations, but did not waver. His strategy is deliberate: avoid a bad deal, wait out the noise, and protect long-term national leverage. Trump expected submission. What he got was defiance, delivered without spectacle.
And when you blow up a relationship as important to that process as the U.S.-Canada relationship, there are consequences.
In fact, a few days ago, it was reported that Canada and Mexico are working on a, quote, Northern Corridor Agreement and to create easier trade between Mexico and Canada without involving the United States.
Economists quickly noted most of Canada's exports to the U.S., about 95%, remain protected under the USMCA. Only a small share is affected by the new tariff. But that small share carries symbolic weight, especially in provinces like Ontario, where politically sensitive sectors like steel and automotive are centered. Former U.S. Ambassador to Canada, David Cohen, publicly warned that these moves are eroding trust. For decades, the U.S.-Canada relationship stood out globally for its stability. Defense, intelligence, and cultural ties went hand in hand with trade. But that trust, painstakingly rebuilt during the Biden administration, has now taken another hit. And behind the scenes, Canada and Mexico are accelerating plans for a $120 billion Northern Corridor trade route, bypassing the U.S. entirely. It's a quiet signal that some allies are preparing for a future with less American reliability. Trump's team pointed to a 3% GDP increase in Q2 as proof of strength. But economists, including those cited by Commerce Department briefings, explained the rise was mostly a technical bounce, driven by a sharp drop in imports after businesses rushed to stockpile ahead of tariff deadlines. In April, Trump had claimed to have made 200 trade deals. By August 1st, the actual number was closer to 8. Canada, notably, wasn't one of them. Trump's strategy is to appear strong, but with every tariff that alienates a key partner, the U.S. risks standing more alone, isolated from the very allies it once relied on. Canada isn't just holding firm. It's quietly walking away from the pressure and keeping its options open.